Welcome back to Wall Street Week. Our special guest this week is Tony Robbins, whose new book, Unshakeable, Your Financial Freedom Playbook, is a must-read for a nation that is facing a dire retirement crisis. Tony, of course, a big issue is financial literacy and the fact that we know that Social Security is running out of money. People are not going to have that safety net when they retire.
Yes.
How do you figure that out when you don't actually have that kind of knowledge?
I think most people aren't going to. I mean, the average American has less than $1,000. You know, if something happens to them, miss a paycheck, they're in trouble. And so my mission is really to change that. So I interviewed, as you know, 50 of the smartest people in the financial world, the Warren Buffetts, the Ray Dalios, the Carl Icahns, David Swensen. And I've asked them, can these people really win in a world where 70% of the trades are high-frequency trades, where these valuations are so high? And they gave me their best strategies. And so I put that in these books. And this last book, you know, my last one was 700 pages. This is 200 pages. Unshakeable, you can read in 4 hours, weekend, time, whatever. And so many people have been waiting for 8 years saying the market's overvalued, or when Trump came in. And what I really found was you have to get in the game. And I want someone who has not begun the journey even, as well as sophisticated people, to remind themselves that the crash that comes, they come every 5 years, we're just overdue, it is a leveler. It gives you a chance to leapfrog from where you are financially to where you want to be if you're unshakable, if you're not fearful, if you get in the game and stay in the game. And what people have to remember is every bull market, every bear market in history, every crash in American history, 2.5 centuries, has been followed by a bull that was explosive. 2008, we lost 50% from peak to trough. But what happened in 2009? From this date on, 69% upside. So if you didn't sell, you're up 70%, 250% right now for the bull market.
Some people don't equate some of the people that you just mentioned, Warren Buffett, Ray Dalio, with fear. Did they have fear? I mean, do they have fear when they're actually putting tens of millions, tens of hundreds of millions of dollars into this market? I
would not call it fear. They're cautious. When you talk to them right now, they're still proceeding. They're saying, look, there are things to fear in this bull and there are things to respect, because no one knows how long it's going to go, and everybody thinks it's over before it's over. So there's been some great research. You know, they all go for asymmetrical risk reward. They all focused, you know, the core four that they share in common, even though some are macro traders, some are people like, you know, Carl Icahn going in and buying in and being the advocate. They all look at, number one, how do I make sure I don't lose money, no matter the market, by having great enough asset allocation. Ray Dalio's whole theory is 15 uncorrelated bets will reduce your risk by 80%. And your risk-reward ratio goes up 5 times. So if you diversify, you're protected. Then they look for asymmetrical risk reward. How do I get the biggest reward with the least amount of risk? How do I risk $1 to try to make 3, 4, or 5?
So that's a hedging strategy, basically.
It is. That's what they all do. So they don't have so much fear. They just have respect for the market. And then they're diversifying, obviously enough, and they're focusing on tax efficiency, so the net dollars they receive really matter. Those are the 4 items they all seem to have in common.
So that's basically what you're doing, too, because you've got these 31 companies in all different industries.
I've modeled them.
Right, okay. So let me ask you this. When they are putting money to work, how important is the overall backdrop for these folks? I mean, are they looking at this company's prospects are going to be really strong for that company, or are they looking at, look, the backdrop of the economy is getting better, the backdrop looks good, so a lot of boats will be lifted?
Well, it depends on who you're dealing with. That's what's different. The macro guys obviously are looking at the backdrop. The individual guys that are looking at an individual company go for it. But for the general investor, what they really need to do is get in the market. If you ask Warren Buffett, he's been talking about it constantly. You got to get in the index. The fees are what kill most people. They got a hole in their boat. The people that do get in the market don't realize the difference between 1%, 2%, and 3% fees is the difference between financial abundance or not even having financial security.
And they're not going to tell you that. They're not going to say, hey, I'm charging you 20%, by the way. I'm going to charge you some high fees right now.
Well, the hedge funds right now, as you know, they're all cutting their fees right now because they've underperformed for the last 6 years.
Right.
So there's a big shift. But what I want people to know is they're not getting in the market mostly because they're fearful. And yes, it's cautious. We're at those levels. But you never know what the timing is. So the research done by J.P. Morgan that was really fantastic. It was a 20-year study. And what they found was, if you were out of the market for just the 10 best trading days in 20 years, instead of having the S&P's compounding of 8.2 per year, which you double your money every 9 years, you drop to 4.5.
You missed the whole thing.
Well, and if you lost 20 of the best days, just 1 day a year, because you think it's frothy, or I think it might come out, or I think I'm going to wait and hold on to my cash, you drop to 2%. You might as well have been bonds. And if you miss the top 30 days, 1.5 days out of 20 years each year, You made nothing.
Wow. So in other words, what you're saying is, look, this market is up 15% since Election Day. Don't be afraid of it.
Yeah, no, what you got to do is keep supporting your 401k, and you're probably going to see a correction, but it won't hurt you if you don't sell because you look at the long term. Every one of those corrections becomes a buying opportunity. I was talking to Howard Marks of Oak Tree Capital, manages $100 billion, right? He was investing $1 billion a week in October of 2008 for 16 straight weeks. He was giddy. He said, Tony, these valuations are the greatest thing in the world. Everybody should be doing this, right? But everybody else is running. So the whole purpose of this book is I'm going to show you and literally get you to have a sense of certainty, not by enthusiasm or positive thinking, by knowing the actual facts so that you don't react. Listen, leaders anticipate, losers react. You can anticipate what's going to happen because there's 2 centuries of history. You're not going to do it day to day.
Yeah.
You're not going to time the market. It's not timing the market. It's time in the market. As long as you stay in there. As Warren Buffett said to me, Tony, he said, I've said this many times, but I want you to hear me right. He looks me in the eyes. He goes, I got to tell you, the stock market is a device that transfers money from the impatient to the patient.
Wow.
He says, if you stay patient and you stay in, or Jack Bogle, he says, look, Tony, get on the market. Here's what I tell people. Stay there and do nothing.
20 years, 30 years.
And it's been an unbelievable formula.
I like what you just said. Leaders anticipate, losers react. That's something to live by. Real quick, was there a common thread among all of those people you spoke with in this book?
The common threads were the obsession with not losing money because the average investor is trying to make money, and they know if I lose 50%, I got to make up 100% to get even.
Thus, hedge.
They all are asymmetrical risk reward, obsessed.
Yeah.
How do I, an example of that's Kyle Bass. Kyle Bass took $30 million, made $2 billion in 2008, 2009. He bet against real estate, but the value was his bets never exposed more than 6 cents to try to make $1. So he could be wrong 15 times if he'd make money. He wasn't wrong 15 times. He made $2 billion.
Wow. Tony Robbins, thanks so much for joining us.